Now to conclude our sector analysis, and before the governor shows up, we've got the industrial forecast from Justin Lamontagne, who's a partner at NAI, the Dunham Group. Justin?
Thank you, everyone. Always happy to be here at MEREDA. Nice to see there's still some folks here in the back standing, so the crowd's still here. It's great. I want to quickly thank my marketing staff, Marina Termel and Lindsay Junkins, for helping me put these slides together, and they also helped me with the industrial market survey, which is downstairs. I hope you all get a copy. It kind of goes over a lot of what I'm going to talk about today. It doesn't work. So here's a brief outline. I'm going to start with the industrial market survey. Of course, we'll talk about current conditions, and then I'll head into what happened this past year, talk about some trends, some anecdotes. I decided to change it a little bit. I'm not going to show a long list of all the big deals that we did. Instead, I chose a select few that are sort of indicative of some of these trends that I'm talking about. I think it would be a little bit more broad and perhaps more applicable to whatever your interests may be. And then, of course, I'll dip into the forecast. So here are the numbers for this year. We are now a market of about 19 million square feet. We have added inventory the last few years. Of that, about 650,000 square feet is vacant. And you do that math, and it's a vacancy rate equal to 3.47%. Historically, that's still pretty low. But as you'll see, that is significantly higher than what we saw last year. And here is that shift. This chart reflects two data points, actually. The first line is cap rates, and that's leveled off slightly. I'll talk a little bit more about that later in my presentation. What I want you to look at is that green line. That's the vacancy rate by year. And you can see over the last, since 2011, just repeated year over year, drop, 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 until this calendar year. So for the first time in many years, we are seeing a slight correction. As you'd suspect, lease rates accordingly were starting to plateau. I think we noticed a slight change as brokers and property owners, so we didn't quite push lease pricing as much as we did in 2017. Now there are some outliers, of course, in East Bay side and West Bay side. Some of the sexier parts of Portland, we're seeing industrial rates as high as 14 or 16 triple net. But for the most part, we've kind of settled in at that $675 a square foot triple net number. Again, historically quite high, but we didn't go up again from last year. Vacancy rates, this chart shows by town. I kind of wish this chart, I gotta work on my charts. There's some impressive charts today. I wish this chart showed last year's results, because what it does show, and I can tell you this, is that every municipality in town that we tracked, we saw increased vacancy rates. This isn't just in Portland. This is across all markets. Portland, there is a caveat, and I'm going to talk a little bit about that in further detail. Sales prices continue to increase, and I don't see any signs of that slowing down. We're seeing demand from investors, from owner users alike. As a result, our sales pricing on average is now $65, $70 per square foot. Peak prices, well over $100 a square foot, believe it or not. Investment pricing even higher than that, $130 in one example I'll show you. I'll talk a little bit more about why there's such a range there later. So those are the numbers. What does it all mean? In my opinion, it means the times are changing a little bit. There's my friend Bob Dylan. There's no question we're seeing increased vacancies. Lease pricing is plateauing a little bit. Actually, let me step back. I want to drill down on that vacancy rate and explain one little thing. At 19 million square feet, our total inventory, we're still relatively small market. So as we've seen in the past, Nate's done the office market, for example, and there's a big building and it impacts the data. That's what's happening here. 7 Rand Road in Portland is a 250,000 square foot distribution building. It's the old Emery Waterhouse facility. Ace Hardware's been in it for many years. They are vacating it. So that building alone accounts for 40% of our overall vacancy. Put another way, if that building was full, our vacancy wouldn't actually be 3.4%, it would be 2.1. So it is still changing, but it might not be quite as dramatic as some of my statistics are suggesting. So anecdotally, we did see a change, though. It is absolutely happening. Right around the spring, early summer, we got a number of 10, 15, 20,000 square foot listings that in years past we would turn over relatively quickly, and for whatever reason, they sat vacant, and a handful of them are still sitting vacant today. So internally we started thinking, what's the problem? What's going on? One simple answer that accounts for some, but I don't think all, is that in the last 2 years we've seen a drastic reduction in the amount of medicinal and, well, recreational marijuana cultivation. The grow facilities that I talked about for so many years and got so many chuckles, we're not doing those deals as much as we were in years past. I think it has everything to do with just a lack of regulatory direction. We still don't really know all the rules, particularly as it pertains to recreational. But that was, I think, just one piece of the puzzle. It goes a little deeper than that. There's some macroeconomic questions and concerns. We started talking to our tenants and sort of asking, what's going on. And the biggest, it's been said up here a number of times, is this lack of labor force. It's a real issue. If you don't have the bodies to fill the real estate, then you can't take the real estate. Additionally, inflation. It seemed, just anecdotally, everything costs a little bit more now, right? Whether it's gas, utilities, a loaf of bread, everything's costing a little bit more. And I think it started to have a little bit of an impact on consumer confidence and big ticket decision making, like buying a building or renting more commercial space. So what does this mean for new construction? I spent some time on this stage last year promoting the fact that our market was ripe for new construction. I think that it was, and to some extent it still is. But let's talk about it a little bit. This added inventory, it is older stock, but it is trading for far less than what it costs to rent a new construction. So that gap that shrunk over the last 2 years as our existing lease rates increased actually took a little bit of a step back. So that's concerning. On top of that, we're still lacking land. There's not a lot of industrial zoned land in Greater Portland. But for one example, I'm going to talk about a little bit later, Scarborough Downs, and that's kind of an exciting opportunity. Construction costs, it's been said over and over again on this stage, continues to be the biggest barrier. However, I was here a couple days ago at the 5 on the Future event through Maine Biz, and I asked one of the panelists, Beth Sturdivant from CCB, sort of her general thoughts on where construction costs were going, and she is seeing it sort of plateauing. So there may be some hope there. This continued escalation in costs might actually be evening out. The cost of steel and lumber are starting to chill a little bit. So there is some opportunity there and some hope. And of course, the new accounting laws. This was much talked about in 2018. There's new standards that require businesses to classify longer-term leases, 10 or 15 years, as capital versus operating, which means they have to reflect them on their balance sheets. So that's creating some hesitation for companies to commit to what it takes a developer to build them a new building, a longer 10 or 15-year lease. I think that's a big reason why a lot of the new construction that we saw in 2018 was really led by owner-users, businesses that bought the land and built it themselves. So is the window closed for new construction? I don't think so, but I do fear that we're somewhat trending in the wrong direction. Though whatever window it was or is today, it certainly is smaller than I would have anticipated last year. That all said, we did see some new inventory in 2018. There was a handful of smaller speculative projects, particularly of note those condos. There's some industrial condos being built in Saco. These are 2 4,000 square foot units that small businesses can go out and buy. There's a handful of units available still today. But the majority, like I said, new construction projects were owner users looking to occupy these buildings. Pine Cove Millworks, A. Dewey Pyle, Richardson Allen, Dennis Burke. These are all businesses that built, all happen to be in Saco too as well. So in a transitioning market, which is kind of what I would call what we're in today, how do we get deals done? And this is a sneak peek at generally what we saw for transactional activity. Sales demand was frothy. We had owner users gobbling up every listing that we could get our hands on. Other brokers kind of suggested the same thing. While that drove pricing up, as you'd imagine, our volume of sales, the number of sales, was actually down again. And again, that has everything to do with lack of motivated sellers, I think, and just lack of inventory. Interest in cash flowing investment properties, very high, as you've seen in all the other sectors here today. We're now regularly seeing industrial cap rates in the 8% range, sometimes as low as 7.5% for premium deals. Owner users, very bullish, still see great value in owning their real estate as opposed to renting. The trend certainly was the case in 18. I think it'll continue into 19. Even in this rising interest rate environment that we're seeing, rising sales prices, a somewhat uncertain economy, none of this is stemming or slowing down interest in owning real estate for industrial users. Like I said, interest rates not really impacting value. I represent a lot of these end users, these businesses, and looking to buy empty buildings. And that's been a hard gig the last few years. You've had to do a lot of digging, and that's led to some off-market deals. I expect that to continue. In some cases, we would find a property for lease, and you just go to the owner and ask if they would consider selling it. So that's a practice that's just necessary in what is a pretty competitive market. And then leases. Leasing, while it did slow in the second half of the year, it didn't just stop. And most of our lease deals were under 10,000 square feet. That's pretty typical for our market. There are still very few options and very tight inventory for any business looking for 2, 3, 4, 5,000 square feet to rent and all over Greater Portland. And again, for the deals this year, I wanted to pick a few and kind of highlight some of these trends. These 3 deals, let's start with investments. These 3 deals have a few commonalities that I think represent what we saw in this niche. Number one, cash is king. 1031 cash buyers really drove this market. Look at 122 Pine Tree Industrial, for example. That's an 8% cap in Portland. Sounds pretty good, but at $137 a square foot, that's an extremely high number. Tim Millett at the Bolus Company represented the buyer there and coached him that, you know, if you're going to buy this building, you're going to have to pay cash because it just won't appraise. 29 Washington Avenue. This is a good example of multiple offers. I'm just going to flick through some of these. Whoops. I talked to Craig Young, who sold that building. Again, 8.5% cap rate sounds good at $100 a square foot, relatively high per square foot number. And but he reported a number of offers. Also, shorter-term leases there, which reflects an increased appetite for risk from investors. That's becoming quite common. 85 Eisenhower, that's a 56,000 square foot building that sold for $3.9 million. T.C. Haffenreffer in my office, and Greg Hastings sold that at an 8 cap. $70 a foot on 56,000 square feet, that's a big, big number. So again, these are investors focusing on the cash flow, the cap rate, not necessarily the per square foot base that we would see with owner users. So owner users, here are a few examples. 65 Pleasant Hill Road, sold for $90 a square foot. Greg and John Rizzo at the Bolus Company sold 75 Scott Drive to Gaftech for $89 a square foot. And Drew Sigfridson and I sold 351 Riverside for $103 a square foot. These are each representative of kind of what I'm talking about for owner users, $90 to $100 a foot, each with multiple interested parties. And these guys are able to use conventional financing. Banks love owner users still. The appraisers are catching up. They're able to quantify these prices and make the numbers work, and we were able to put those deals together. Sorry, I was not clicking. Here's some lease examples. I leased this space in Gorham. Again, not the largest or the biggest deal of the year, but indicative of these smaller lease deals that I was talking about. It was the only vacancy in the park at the time, and we were able to land a tenant in very short order. I mentioned the second half slowdown. The number of 10 to 15 to 20,000 square foot spaces that we picked up really all happened in the second half of the year. 101 McAllister was leased to Brickell Men's Products. They were working with Mark Fishman for several months in the beginning part of the year. And I think this building leased just in time. Interestingly, if they were in the market in the second half of the year, they would have had a number of other options. So again, just sort of indicative of something changing right around the summertime in our market. Price per square foot, these are still very high. Lease rates, we're averaging $650 to $750 a square foot. Larger tenants, you know, interestingly, there's pros and cons of being a large tenant in a small market. I think moving forward, larger tenants are going to carry significant leverage. We're seeing some loosening of inventory for larger spaces, so I suspect that might continue. And then limited new construction leasing, specific to leasing. There was not a lot of developers or build-to-suits renting spaces for new construction. Nationally, I'll be very quick because I know we're running short on time. We're not running short on time? Oh, drag it out? Sweet. I saved all my jokes for the end. The story nationally is somewhat similar, but they've got more of a healthy vacancy rate. 8% is nationally roughly the average. New supply has slowed down. I think they're starting to hear and sense some of the macroeconomic concerns that we're hearing locally. But for e-commerce continues to build large distribution sites. Interestingly, locally, we're starting to hear rumors that Amazon is looking for what they're calling a pop-up distribution facility, you know, a 10 or 15,000 square foot small facility. I think to kind of test the waters here. and maybe with hopes to build something larger in the coming years. And then investment demand, like here in Maine, national investors, I think, have realized that industrial, along with housing, has the longest term potential of any commercial real estate asset. I don't expect that to change in 2019. And speaking of 19, here is my forecast. There are some larger vacancies still on the market. I mentioned 7 Rand Road. That's the large one in the middle on the top row. It's a great building. It's 250,000 square feet, though, so it's a bit of it really stands out in this market. I'll make some predictions. I don't anticipate smaller scale construction like those industrial condos in Saco. I don't think we're going to see a lot of that type of inventory added. In a small market like ours, we really need to see those get absorbed before anybody tries something new. So that could take 12 or 18 months. I do think at least 1 and perhaps 2 large 50,000 square foot facility will break ground. And you might ask, how is that possible with some of these challenges that I'm discussing? I'll reiterate what I said, that owner users and end users, and in some cases, and in this case, the 50,000 square foot user, might be in a position where they have to build. There's just no other option. And in that case, demand will usurp whatever the cost might be. One company, for example, Harvey Tools, did announce recently that they are constructing a 50,000 foot building in Gorham. I think they're going to break ground sometime in summer. There's another second user that I'm aware of. It's looking in York County and southern Cumberland County. I'm confident they won't find an existing facility, so new construction might just be the way to go. Investment demand, I suspect, will continue to be quite frothy, but I do think cap rates will plateau just a bit. I think investors really can only take so much risk until it doesn't make much sense. Also, what's attracted a lot of regional and national investors to Maine historically was our lower cap rate, or our higher cap rates. As ours continue to creep closer to Boston rates, you're not going to buy a 6.5 cap in Maine if you can buy a 6.5 cap closer to Boston. I just don't think we'll compete. Owner-user sales prices. I think there's a little bit more room to grow. There was enough demand, but very soon those $100 a foot deals that I referenced are going to get close enough to true replacement costs where the buyers will just say, I will go find industrial land and I will build. So I think the pricing will stall somewhat in the next year or two. And then lease pricing, I also think will settle in. We just need a little bit of time, I think, to gauge this new market. Tenants and landlords, at $650, $675 a square foot, you have to remember this is still historically uncharted territory for our market. So I think we're going to just see how the market responds, see if we can fill some of these current vacancies, and then we'll readjust perhaps later in the year or 2020. And then I threw in a few questions, and like in years past, one of the most common questions that I get is about marijuana and the growth of marijuana. What impact recreational will have on us. As I mentioned, there weren't a lot of transactions. There just weren't. So there is still interest, and we're getting inquiries. But frankly, there's some speculation that the medicinal growers that we did all these deals with a number of years ago, they kind of have the market cornered. So whatever need there may be for new recreational grow facilities might just be able to be absorbed within those originally designed medicinal spaces. So I'm not anticipating a huge impact from the recreational marijuana industry. Craft brewing, a lot of questions. The number of craft breweries continues to escalate. So is it slowing down? Yes. Is it coming to an end? I don't think so. I really love the industry. I appreciate and kind of admire the entrepreneurial spirit. I love the way they leverage their real estate and make their real estate a part of their sort of culture and vibe. Yesterday, there was an article in the Bangor Daily News about this industry adding $260 million a year to our local economy, so just phenomenal. And the other phenomenon that's happening there is they're becoming more, they're calling it hyper-local. So as opposed to your local bar, you're going to have a neighborhood brewery. And that's how so many are staying open. I don't anticipate another rock star brewery like Bissell Brothers or Baxter Brewing to become huge. But I do think you're going to see smaller, more niche-based breweries opening up. And they're sustainable because they're catering to a very specific crowd or niche or area and as opposed to the masses. Scarborough Downs, they're downstairs. If you haven't checked out this development, it's pretty exciting. From an industrial standpoint, I applaud and I thank the developers and the town officials for exploring and ultimately creating a portion of that site to be industrial zoned. I think that the location, the infrastructure that they're going to add, the way they're marketing it is pretty creative and interesting. They're really creating turnkey pad-ready sites. I think it's going to be a winner. We've had a number of clients look at it. The Bolus company is doing the marketing. It's not cheap, and they'll be the first to tell you. It's not going to be inexpensive, but it is easy, and it's and again, like I said earlier, for certain users, demand just might trump cost. And so with everything I've said today, the question I get a lot is, is the landlord's market coming to an end? No. No, it's still very good to be an industrial real estate property owner. I think in certain situations, tenants might have a little bit more leverage than they've experienced in the past, but for the most part, it certainly still is a landlord's market. And I will conclude with the much anticipated results of the Patriots game, 34-27. Going to another Super Bowl.